Personally, when I look at the flows and I look at the 2 year, just 2.5 year now, massive amount of silver pulled out of worldwide markets. I mean, massive. Okay, that tells me that we're getting closer to potential silver squeeze. We're not quite there yet, preconditions, but I wanted to start calling it out to you because. Everybody, this is Rob Kientz with GoldSilverPros.com, bringing you this week's weekly market wrap-up. Reporting this on July 28, 2023, about 3 p.m. Central Time. You guys will see it a little bit later this afternoon. And we've got some interesting stuff going on with world gold flows. The data is just interesting. Same thing with silver. Something's going on. Stuff is flying all over the place. And we're going to tell you what's going on. But first, before we get into gold and silver, as you know, we get in to the data because we're a data channel. So we're going to talk about the economic data, what's going on, the macro scene. Well, something interesting happened this week. I kind of had a reversal of fortunes between the two largest categories or segments of the economy, if you will. Manufacturing is going up. Say what? Manufacturing hasn't been going up for a while, and services is going down. Now, services is the biggest part of the economy, and it has retracted from a 54.4 print last month to a 52.4. Now, anything over 50 is considered bullish and growth oriented. Anything under 50, that's sort of the Maginot line for this statistic, is slowing down. So it's not, the services is not going negative, but it's slowed a little bit since last month. Manufacturing almost is at break even. It's still contracting just a bit, but it's up at a 49 print. Last month it was at 46.3. So why is manufacturing going up when services is going down? Well, that part of the economy, services, was probably bubbled up a little bit, and now it's starting to come back down to reality. And the manufacturing bit is going up just a bit, probably because of supply chain constraints and businesses reorienting to serve the American and local markets, try to fill in the gap in some of the stuff that we had been missing with supply chain problems. And that's actually a very good sign. I would love to see manufacturing continue to go up and services continue to moderate just a bit, not because I want service industry to get hit, but we need more manufacturing as a percentage of our economy to become more self-sufficient and more independent, which we're probably going to need to be going into the next recession, given the current realignment of geopolitical trade flows, which we've talked about quite a bit on this program. Well, other interesting information came out to support the fact that manufacturing is going up. Durable goods orders really spiked up 4.7%. Expectation was only 1.5%. That's 3 times what the economists expected. Last month, it was up 2%. So this is a bigger than normal and a bigger than expected move in durable goods orders, which means that's good. People are starting to buy durable goods. Manufacturers are starting to buy them. And it's spurring a little bit that part of the economy. And if we could just kind of ease that along and nurture that a little bit and get manufacturing running again, we could spur this economy and not just sit here and wait for the services economy to crash during the next recession. Other data is interesting. The home price index put out by S&P Case-Shiller is down 1.7%. Housing continues to contract. Now, I did see a report in mainstream media that housing is back. It is not back just yet. It had a little bit of spurt in terms of new and pending home sales, but still the home price is going down and overall demand is lower than it was. Consumer confidence has spiked to 117 on what I don't know because the economic data is not really any better overall, but consumers seem to be a little bit more ready to open up their wallets and thinking the economy is doing a little bit better. Employment's not too bad. That might be part of it. 221,000 initial jobless claims in this week's data put out on Thursday, on expectations of 235, so a little bit less jobless claims than we expected, meaning maybe more people are going back to work or they're rolling off the doles as they've been on it for a year, and those initial jobless claims do not count anymore. Even the continuous ones don't count anymore after a year. GDP was up 2.4% month over month, which is very nice. That's a nice little growth. Now, inflation is still a little bit higher than that, so if you decrement it for inflation, we're not really growing. But at least that number is positive and not outright declining. That is a good sign, although it's not nearly enough to make up for some of the declines that we've had. Pending home sales are up 0.3%. It's not a lot, and that's why I say housing hasn't completely come back. Inflation data is down, and in fact, the Dow rose 150 points today. The pundits on CNBC are saying that's because of tame inflation data, which I would agree. Inflation data is coming down. Now, I think this is temporary. It will go back up, because all the problems that we have not been resolved. We've not worked out the debt in the system. There's too much money, but we're having a nice little boost here between periods of inflation or cycles of inflation. That is what's going on. Moving over to the stock markets, Dow Jones is up. As I said today, it's up actually 169 points now. As we look at it, S&P is up 43 points. NASDAQ up 260. That's really nice. the most of any index. That's 1.86%. And the Russell 2000 is up 26 points, which is really nice as well, 1.36%. So technology and small caps leading the way today. Bonds are pretty much where they've been, honestly. Some of the shorter term bonds are sitting over 5%. In fact, we have over 5% interest rates on everything shorter than a 2-year. The 2-year comes in at 4.887. Now, all bond rates have fallen today. It's all in the red, which is a nice sign. When bond rates fall, it means that bond investors expect a little bit less risk in the near term, although it's still pretty elevated from where it was a year, 2, and 3 years ago, and certainly from the last 14 since the last recession. So expected the bond rates would rise a little bit as we enter the next one. The 10-year is at 3.961. Therefore, we're still in yield curve inversion with the 2-year demanding more. In fact, everything shorter term than the 10-year has a higher rate, meaning people still expect an oncoming recession. We've had a little bit of a pop in the cryptocurrency markets today. Bitcoin is approaching 30,000. Price is at 29,317.33, up $182 today. Ethereum is up $15.31 to 1874.32, and Litecoin's up about 22 to 91.3. XRP is rounding in at 71 cents. It got about a 30 cent bump when XRP was ruled not a security by the SEC in most cases, unless it was sold to institutional investors. And XRP, having, I guess, won that case or won most of their case against the SEC, is now trading a bit higher, although it hasn't really risen above $1. So I think the market's still a little bit mixed on what XRP eventually is going to do and to be, but we're going to continue to follow that because I think it's going to be very important when the CBDCs come out. Stay tuned for more information on that. Going on to the stories of the week, U.S. gasoline prices reach an 8-month high. It says here from oilprice.com, author Julian Geiger says, U.S. retail gasoline prices reached their highest levels since November. Average gasoline prices have risen by 13.4 cents from a week ago today, according to AAA data published on Thursday. The current price for the average gallon of retail gasoline in the United States climbed to $3.71.4 per gallon on Thursday, up from $3.69 per gallon the day before. A week ago, gasoline was $3.58 per gallon. ExxonMobil had to shut down a gasoline unit at one of the largest refineries in the United States for expected repairs at the beginning of the week, sending gasoline futures up more than 5% on the news. By the way, Exxon profits are expected to be down just a bit on the higher costs. However, they are expected to pay out about $32 billion, I believe, to shareholders, if I read that number correctly. So they must be doing okay. So the surge in gasoline prices is helping the oil companies. However, it eats into their profits a little bit, and eventually they pass them on to consumers, and that's where the pain comes for consumers. Of course, we're in the hot summer months. We're heading into August, the hottest month of summer, certainly down here in Texas for most of the United States. And we have an article here that says, largest U.S. power grid declares emergency alert for the second day. PGM Interconnection LLC declared another energy emergency alert level 1 through Friday. Excessive heat advisories and warnings cover much of PGM's grid across 13 states, from Illinois to New Jersey, with over 65 million customers. Here's a map of the PGM grid. Well, I'm not going to, I read that quote. I'm not going to show it to you on the screen, but it basically encompasses a lot of the East Coast, a lot of the Eastern Midwest, states northeast of where I'm at in Texas, including Oklahoma, very north Louisiana, Arkansas, Alabama, Georgia, and all the states in between, running all the way through Pennsylvania. PGM has issued these alerts to help prepare generators for the onset of intense heat, the grid operator said. So if you have a Jenny, start running it if you're in those states because they're expecting some major issues. This is the second day, according to the article, that the largest U.S. grid operator declared a level 1 emergency. On Thursday, PGM's preliminary peak load was around 148,000 megawatts and is forecasted to peak at around 155,000 megawatts later on Friday. PGM expects hot weather to persist through Saturday. Bloomberg data shows average temperatures across the lower 48 are expected to peak on Saturday and possibly revert to 5 to 10 to 30-year averages. That's nice if we get a bit of relief. It has been a very warm summer down here in Texas. We got official triple-digit 100-degree Fahrenheit weather before the official onset of summer in June 22nd, June 21st time frame. So we knew we were going to be hot, and it's nice to see that they're expecting the temps to fall back down just a bit. One thing that I did want to show you up on screen is this very interesting infographic put out by Visual Capitalist. this is what they do, and they do it better than just about anybody. These are the 20 fastest growing and declining industries in America. If you want to know where the economy is going, this is a nice little eye chart that will tell you. Notice here on the left that healthcare is doing quite well. At the bottom, professional and business services is doing well. Leisure and hospitality has started to grow again, which is nice to see after all the wreckage of the pandemic did to that sector. It's nice to see that people that work in that sector can get back on their feet and that people are spending a bit more on that, although we expect consumer spend to continue its slow downtrend as we inch toward the next recession. Services is doing very well. Mining support and activities is doing well, except for coal mining is down. Agriculture is doing well, but logging is down. Manufacturing is actually taking a hit. And this is where I said it'd be nice to get manufacturing back earlier in the presentation because it's been hit so darn hard. So any growth in manufacturing we can get is good. Overall, manufacturing sector accounts for 14 of the top 20 declining industries, with CD, tape, video game cartridges down, tobacco down, apparel and leather down, engine, turbine, power, transmission down, lighting and equipment down, textile mills down, office furniture down, iron ore down, agriculture, construction, and mining down, metalworking down, general machinery down, printing down, railroad rolling stock down, other furniture down. And this is between 2021 and 2031 where they think that this will continue. Thank you for the chart from Visual Capitalist. It gives us a really nice, like I said, little eye chart telling us what's really going on in the economy. We're going to move over to gold now and look at the gold charts. We're in the precious metals section, your favorite section of the weekly market wrap-up. You can see that there's elevated open interest in the market. Things are getting frothing. We're not even through the summer months. People are betting on gold right now. This is a positive sign overall. I'm telling you right now, we did not, or so far, knock on wood, have not had the summer swing that we normally have in the gold and silver markets. That indicates to me that the oncoming recession fears and the bank failures we had earlier in the year, along with inflation data tamping up, is that the market expects gold and silver to do really well in the fall. It's a result of maybe not so hot news. So if you're not into gold and silver, you may want to consider getting in if you haven't already, because it tends to be contrarian to the rest of the economy. So if the economy is going to go in recession, gold and silver tend to do very well. Of course, please do your own research there. We're not your financial advisor. As we go down into the data, gold is very interesting when gold flows. I'm going to talk about EFPs again in a moment, but I wanted to outline the tail of the tape for the overall futures market. Now, remember, this is futures market. It's largely a large input into what's calculated as spot price. A lot of people will tell you spot price is determined on the London OTC market, but to be honest, the American market is very close and prices are very close. And I think most Americans are traded using both data sets, if you will. And there's an arbitrage opportunity which does peel into the EFP, if you will. So there are different pricing mechanisms. There's not one global spot price, I'm sorry to say. So I tend to look at both. Anyway, without further ado, on we go. We can see that December's lining up for the dominant contract month for gold right now. It's got 379,326 currently open interested contracts. Again, this is a futures market. People are betting on the price in December. We added 16,000 contracts this month, as you can see on the data. We also added 2,849 to October. October setting up as maybe a mini nice delivery month with 31,000 open interest contracts. When you have more open contracts, you have the chance for more physical what? Deliveries. You can see here in July, we only had 24 deliveries. Why? Because we only had 25 contracts and we only got 2 left. So guess what? All the contracts for July have been delivered. It makes sense because we're in July 28 at the end of the month and people are lining up for August. Now remember, the way that the COMEX works for deliveries is that the last 2 business days of the month count as the first 2 trading days of the next month. So in other words, the last 2 business days of July will be the first 2 physical redemption days of August. In other words, if you're looking for physical redemption off this market and not just to trade paper, you can start a couple of days early. And that's intended to give time for the shorts to deliver the metal, because COMEX delivery process generally takes from 2 to 3 days according to their own data. So they give you a 2-day head start to allow, when that new month comes in, the shorts to deliver that metal if they're going to do so. Overall, going back to EFP, that is where you take a futures contract on COMEX in the American market and you exchange it for a contract on the OTC, which is the London market. And I'm going to show you how that works. Essentially, well, actually, I don't have it up on screen, but essentially how it works is you exchange, ladies and gentlemen, a contract over to London and in London. Oh, I have it right here. Sorry. Here's how it goes. Exchange for physical allows traders to switch gold futures positions to and from physical unallocated accounts. That means London. And it says if a dealer sells the EFP on the American exchange, he is selling the futures contract. That's this one. Okay. and buying the physical gold equivalent in size in London in the OTC market. It says physical gold equivalent. It's not saying that you immediately get to take delivery, but on the London market OTC contracts, you have that option. But that's such an opaque market to outsiders. They don't put out the data. We don't know that every EFP here, 1210 for August and 2600 contracts for December, are actually physically being delivered. It may just be exchanging one derivative product for another in another market, maybe to get more immediate price exposure to that market, or to do something else. Maybe they're international companies and or organizations that are playing both markets and they're just adjusting positions. But generally, when you see elevated EFPs, it means people are hunting for something. Either they're hunting for higher prices in the other market, or they're hunting for the physical. What does that mean? Demand is increasing. The more EFPs, the more demand you want. You're looking for higher prices or the metal itself. EFPs are bullish as they go up for the gold and silver markets, and we see quite a few EFPs here. Let's go over to the settlement tab. You can see I'm clicking right here. And what that does is it gives you the daily price range. Now on the settlement tab, they will give you interim data during the day, whereas on volume and OI, it's only printed at the end of the day. So the cool thing is you can read right here, and it says that's updated about an hour and a half ago as I'm recording this video. So it's not end of day data, but it does give us same day data and gives us a trend of what's going on. So far, gold trading on the dominant contract months of 1470, and on the next big month with 31,000 contracts, 1470. And guess what? In the current month or next month's contract, 1470. So there's no backwardation here in the gold market, which means it's a healthy market. And prices have gone up today. If we look at what happened on Thursday, we fell $24.30, $22.40. So gold had a down day, but it's a nice rebound today. And if we go back and look at the volume and open interest, this was from yesterday. This was selling. Next week, we'll see the 28th data, and it will be buying. And that's nice to see in the gold market. Moving over to the nice chart on where is the physical. This is back to the physical part of the gold trade. Here's COMEX, which is the American market. You know what's really interesting about that? Over the last 4 weeks, gold deposits have basically gone up just a tad. Silver is a much bigger change on the COMEX. But in London, they've gone down. And overall, between the two markets, they've gone down almost 1 million ounces. People are redeeming for physical, whether overseas or here. They want the gold. And when you add that to the fact that gold is going up, that's where it comes. And these EFPs here, this 1210 here and this 2600 here, when you look here, that comes out of these depositories when they take physical delivery. You see how that works. That's why we like this nice chart of both markets. You can see the interplay between the two because they're sister markets and people trade between both, not just the paper, sometimes physical. And that's why you have more green in COMEX and more red in London. What does that tell you? Gold's flowing from that market to which market? This one. And it goes back and it goes forward. And it's just nice to see how that goes. I've got a very special story in gold before we get to silver. And I did an article on JM Bullion about that. It's called New Study Shows That Millennials Are Now Buying the Most Gold. Well, here's an article from Yahoo Finance. The survey was from SPDR, which runs the GLD and SLV respectively for gold and silver. Those are ETF funds. And it was printed by State Street, which is the fourth largest investment company in America. It says here, millennials are beating baby boomers and Gen Xers when it comes to investing in gold, according to State Street. Demand for the precious metal, widely regarded as a safe haven asset, remains strong as a recession risk loom. Gold has rallied almost 9% year to date and is approaching the key $2,000 per ounce mark. In fact, it's up today, ladies and gentlemen. As such, the precious metal is possibly an ideal choice for older, wiser, and more cautious investors, such as those from the baby boomer generation. According to the world's number 4 asset manager, millennials are the biggest investors in gold, beating baby boomers and Gen Xers by big margin, according to State Street. On average, quote from the report, George Milling Stanley, chief gold strategist at State Street, on average, millennials have a higher allocation of gold at 17%, with boomers and Gen X lagging behind at just 10%. And millennials reported a greater appreciation for the convenience of investing in gold through exchange-traded funds. Now, what does that translate to English? Millennials like the paper version because they can do it on their apps and in their brokerages and maybe in some of the 401ks if it's available, not really all that much. But they like to trade it that way. They don't necessarily like to take delivery of the physical or buy allocated physical in a depository somewhere through one of these companies like Brains or Loomis and all these companies that offer that. They really want to go for paper exposure. I know that most people will say, well, that's not going to get you the gold. The GLD and the SLV will not allow you to redeem your shares in GLD or SLV for gold or silver, respectively, unless you're one of the authorized participants with 50,000 shares or more. And there are only a few of those. And they're basically banks and those types of houses. So the average individual or even wealthy individual ain't going to get them. But that being said, it shows that the millennials are waking up to the benefits of gold, and they will wake up to the benefits of silver. And eventually, I think as the recession gets worse, they're going to go for the physical. They're going to sell their GLD on S&P and go for physical, just like the Gen Xers did during 2008, 2009. And everybody did during Silver Squeeze 2 years ago. The millennials are going to wake up and do the very same thing. So this is bullish. Why? Why do we care? Why do we care about the millennials? Well, first of all, I care about them in general, but we also care because this is future physical demand. The fact that millennials are getting more into gold, this paper is going to turn to physical when they want the physical security of gold and silver. That means demand's going up from the largest generation in the world, 2.1 billion millennials across the world. If you don't think this is a power generation waiting in the wings, ladies and gentlemen, watch what happens during the next recession. They're going to take over and dominate, because they are going to have the buying power. I think they're going to be kind of mad because of the recession, to be honest with you. Moving on to silver. Silver spiked up a little bit in open interest. That means we got a price movement, and it's up, and it's really good. Let's look at the E&P data. Exchange for physical over to the other markets, not so hot in silver. Why? Because we have probably more silver stocks here, and there's been a surge in silver stocks coming. We'll get to that in a minute. The dominant contract month right now is still September, although it's moving slowly over to December. It's moving more slowly than gold, though, which tells me people are betting more shorter term on silver price movements. And that makes sense because silver is more volatile. It moves up and down more on a short-term basis. So it takes a wee bit longer for silver investors to go longer term on their futures. They want to stay shorter term because there's more volatility, which means more chance for what? Loss. More chance for gain equal more chance for loss. So you can be a little bit more conservative. Moving over to settlements data. Today so far, as of about an hour and 45 minutes ago, silver's up about 13 cents on the day. And, well, you silly little. There we go to Thursday's data. And yesterday it was down 60 cents. So silver's had a little bit of a wild ride this week, a little bit more volatile than gold, which is normal, but it's moving the same direction as gold, which means they're moving for the same reason. When gold and silver move for the same reason, it's investment demand. Silver is used more industrial than gold. They both use industrial, but more silver is used for industry as a percentage of the total silver produced than gold. And when they move in tandem, that's a sign that it's not just industrial demand, ladies and gentlemen, it's investment demand. Moving over to COMEX silver stockpiles, you can see that while eligible stocks has increased overall, the registered stocks have not. Registered is what is actually delivered on a physical contract. Eligible stocks is just warehouse storage and doesn't necessarily have anything to do with the market. It could be people they bought silver on the market and they left it in the COMEX depository, or they put it separately in COMEX depository and they never wanted it to be on the COMEX exchange for a futures contract, for exchange, for physical in a contract month, a delivery, if you will. So how much of this is available to eventually move to that market, move out of private hands? It depends. The private hands may not want to give it up, or it may be going to Samsung, Apple, or these other merchants that use it. You never know. This is like a staging point for silver around the world. So the staging point in U.S. for silver to move around the world has gone up, but the actual tradable silver has gone down. This is why recently I said there are conditions setting up for a potential silver squeeze. It's not here yet, but if registered stocks continue to move down and you don't see a big influx from this eligible stock, meaning it's already accounted for by industry, that means that investment demand will bankrupt registered stocks. We don't know that's going to happen now, but there is a possibility. Now, going over to the big chart you can see on COMEX, here's the increase of 8 million ounces in the last 4 weeks into COMEX, but again, it's eligible. What is eligible, ladies and gentlemen? It's this one. It's not the one that's immediately available for exchange, and CME Group has said they don't know how much because it's private contract. They can't tell you how much can come on. They said they guesstimate a couple of years it could be 50%, but that was a shot in the dark. They really don't have a darn clue, to be absolutely honest with you. It's interesting to see that a massive amount of silver has come out of SLV, 16 million ounces in the last 4 weeks. About half of that went back over to the COMEX. Where's the silver going? It's going from London to the U.S., but it's not going into tradable silver. It's going into stockpiles. Does that mean manufacturers are buying it from London and sticking it in the U.S. as a hedge against silver price increases, or for current demand for silver, which we know is short every year? This year is estimated by the Silver Institute over 200 million ounces, and a 4-year trend of the mines not putting out enough silver to feed industry. Okay, we have a deficit. So is this that move into eligible to conquer that manufacturing deficit? Or is it going to be put up for investment demand on the cut? We don't know, but it's clear that more silver overall has moved off than's moved on to the tune of 15 million ounces. So silver has continued to be liquidated from worldwide depositories. Some of it's coming to the U.S. We don't know how much of that can be available for us investors who want to buy it. So before we say there's plenty of silver in American exchange, we don't know, but it's interesting. The flow tells you a little bit, at least, about what's going on. And the flows in gold and silver are interesting. Silver, much more pronounced. Again, it's used more heavy in industry, which makes me think a lot of that movement is over, either to expected American industrial demand or current American industrial demand, or to make up deficits in contracts on things like unallocated silver that people want to change into allocated, so they're going to store it in a depository. Remember, you can store it in one of these COMEX approved depositories, and it can be something where people buy it through Brinks, through one of these brokers, and it sits right there. So it could already be owned by an investor or by someone else. You don't know. We don't know. We don't have that data, but it certainly looks very interesting. Personally, when I look at the flows and I look at the 2-year, just 2.5 year now, massive amount of silver pulled out of worldwide markets. I mean, massive. Okay, that tells me that we're getting closer to potential silver squeeze. We're not quite there yet. Preconditions. But I wanted to start calling it out to you, because unless that 8 million ounces in eligible increase gets dumped on the open market, which is highly unlikely all of it will, we could be getting a lot closer to a potential another silver squeeze. And remember, it was 110 million ounces in 3 days during the original silver squeeze. People buying through SLV. So 8 million ounces over 4 weeks ain't enough to solve that deficit. So are we out of the woods on the silver squeeze? Heck no, I think we're moving closer toward it. Now we're inching a bit, because the London market kind of bailed us out a little bit with some of those inventories, but we don't know how much of that is going to be available to actual investors versus it's already accounted for somewhere. And that's kind of how that market works. So to some, economy's kind of up and down a little bit, but overall inching toward a recession. We had a nice little boost in manufacturing, but as you saw on the Visual Capitalist presentation, manufacturing was slammed so hard, this little mini move this month is really not going to make a dent. We got a long way to go. And that, I hope you guys have a wonderful weekend. Try to get out of the heat. It's hot. If you live in PJM's service grid, please, if you can, afford it. And especially if you have babies at home or elderly people particularly sensitive to the heat, please go buy a generator. Help the grid by hooking up the generator and running, which you can, of course, do it legally according to your local ordinances. Make sure you're not putting it straight on the grid and shocking people. Hire qualified electrician. Follow your local building codes. Be safe when you do this, ladies and gentlemen. When you stick electricity onto the grid from your home, it needs to be done a certain way so it's not during a blackout to electrify a service operator on the lines. Make sure and follow all of your local guidelines, please. But get your generators at the very least to be able to cook, maybe to run a single room air conditioner, keep everybody cool. Put it in the kitchen, okay, and put some blankets and things to shield you from the rest of the house, and run it in there and keep people cool if you have to, or in a bedroom or whatever you got to do. You know, just don't let people get out in this triple-digit heat and get dehydrated and heat exhaustion, please. Everybody, please have a wonderful weekend. Until next time, this is Rob Kientz with goldsilverpros.com.